Welcome back, everyone. My name is Adam. I have Rusmin.
Hello.
And Victor.
Hi, everyone.
Thanks again for joining us today. We're going to talk about the potential interest rate cut by the Fed. So the Fed is going to meet, they meet every few months, correct?
Yep.
And the next one I think is going to be in September 17th or 18th. I think that's the date that the internet puts out. And there's a lot of news saying that the Fed is probably, and I say probably because we never know,
High probability.
a high probability that interest rates are going to be cut. So if that happens, and we don't know by how much, most probably 25 basis points, but who knows? The question is, so if that happens, is that going to affect our portfolio decisions in the near term? So we're going to discuss that, especially those asset classes that have more direct exposure to interest rates, and what would you do? We're going to talk about that.
I think the interesting way they put it is that the Fed official just says that it's hard to imagine no rate cut in September.
Hard to imagine.
Hard to imagine.
Okay.
So that's not a guarantee. Right? So, and it's a very vague statement, and they've been doing it. And the rate cut expectation actually has been like ongoing since late last year to earlier this year, right? And until today, we have not seen any rate cut. So with the data that they use to decide whether there's going to be a rate cut or not, typically they will decide based on the unemployment rate, right? And also they will look at like your inflation data. And so far, inflation data has been coming down, and that's a great stuff because on average they are aiming at like 2%. And the latest one that they're going to release is going to be, by the time this video is up, the day they're going to announce it, whether the inflation is going to continue to fall. Okay, but I expect that it might continue to fall, right, or either stay the same, right? And but on the other hand, we are also seeing the unemployment rate is creeping up, it's going up. Okay, so and that's why I think there's urgency in the sense that the Fed has to do something, otherwise this may get out of control. Once you have more people are getting unemployed, then the whole economy may spin onto the other to the south, right?
So that's why Powell said the time has come.
The time has come.
Okay, we'll see.
Okay. So chances are, I think we all can like pretty much agree that pretty high. All right, but if you look at the what should we do, right? In the event when the rates start to cut. I think I came across this particular table where by Endowers, right? So credit goes to them. I actually saw it on the Business Time, which they published it there. They did a study on all the past rate hike and rate cut over the last like 30 over years, like since 1990s. And they go and calculate all the returns across different assets. Be your equities in developed market, emerging market equities, your bonds, your Nasdaq, S&P 500, your gold, commodities, and then measure the performance at a time when the rate start to hike, and towards the end when the rate start to the hike stop. Okay, and same thing they're going to study the time when the rate start to cut till the time where the rate cut ends. Okay. So on average, I'm just going to focus on the rate cut, right? Performance at the time when it start and then towards the end. And they actually found out that developed market equities actually underperform by 15%. Okay. And emerging market actually underperformed by 7.9%. And interestingly, the one that actually performed very well is bonds, 11%. During the rate cut period.
But that kind of makes sense, right? When interest rates go down, bonds that had higher coupon rates, prices of them will go up.
Yeah, because money will flow into those bonds portfolio, right? And that will push up the prices of the bond, and that is the reason why bond performance usually tends to do a lot better in the rate cut environment, right? And then gold, I think surprisingly also did quite well at 6.6%, and commodities generally were down by 9.5%. I think this is like for people who have like invest in multi-assets, you kind of like always switch around. But for us, I think we usually look at simpler assets like your REITs, banks. These are instruments that are very sensitive to the interest rate environment. And I think today we're just going to focus on that.
So before we move on, I think now we are saying in terms of the probability of interest rate cut is very, very high. But we also need to know that that in the past, the Fed have flip-flopped many times also. When they say they want to cut, then when the time reach,
they've been giving us blue balls for a long time.
So what I'm trying to say is like, now we understand that, the probability is high that you will cut, but you also must take note that there's also chances that it will remain the same. And I think the cut will probably be just a small percentage, maybe 25 basis point. It won't be huge also, right? Because the inflation data came in July is about 2.9. The August one have not came out yet, right? So the target is still 2%, right? So if they cut too much, it might push back the inflation again. So we also need to take note that it's just I think it's the probability of gradual cut is much higher than a sharp cut.
It makes more sense that way, right?
Yeah, and if you're expecting going back to 0%, I think unless a very big crisis happen, I think the chances of it happening is very low.
Yeah.
Right?
So don't expect like an overnight situation where it's suddenly
correct. And also be prepared if there's a flip flop again.
Okay. So we're going to go back into the things that we like to focus on, because a lot of those of you who watch this channel, we talk about Singapore banks, we talk about Singapore REITs, because they're super stable, the good ones anyway, in terms of their dividends and their growth. But recently, I mean, for the last couple of years, REITs haven't been doing so well in Singapore because of the environment. So is this going to change how you look at REITs? What's your near-term outlook, I would say?
I think I'll just bring us some factual data on the IS REITs that have actually reported their first half result, and which, if you look at their DPU overall, I think Business Line also did a compilation on this. 29 REITs actually reported lower DPU, right, based on their first half result. Only 6 managed to report increment in terms of DPU, okay, and one of it actually have no change in terms of DPU, right? And the fact that why so many of them actually reported negative distribution per unit or dividends is because of the rate hike that we have seen in the last couple of years. This was probably the steepest rate hike that we have seen in the history, right? And a lot of REITs, when they have to refinance their loans for the last couple of years, they have to refinance them at a higher rate. Right, and because for the past many years the rate was like almost close to zero, only that phase where 2018 to 2020 before COVID, and that was like like higher rate environment, slightly higher rate environment. But generally most of the REITs have their loans at very low, very attractive. Okay, and because of this steep rate hike, that's why you've seen this impact going in, affecting some of these REITs that are reporting lower DPU. Right, so last 2 years, I think we have seen a lot of loans are being refinanced at a higher rate. Okay, and this with this rate cuts coming, okay, I think a lot of people are sort of expecting that REITs, the reverse will happen. Okay, and that again really depends on whether the rate cut is going to be a steep rate cut, which I think at this stage is highly unlikely, unless we go into like huge bear market again. All of a sudden there's a bear market, the whole unemployment spin out of control, right? But it looks like to me a slow and gradual decline of rate cut over time. Okay, so this will benefit REITs for sure. Okay, because as they refinance some of the loans that they actually took up, a couple of years ago, they may start to see that coming down. But I think in the second half, we may still see that a lot of REITs report lower DPU because some of those loans that were being refinanced like 3 years ago were still low, right, during the COVID time. And at today's rate environment is still higher if they were to refinance those. So I think that will still continue to flow in the second half. We may only start to see this positive result coming in if there's really a rate cut or things like stabilize, there's no rate increment starting next year. Right, and interestingly, the price of REIT have already started to run up at the time of this recording. Yeah, so if I were to look at the performance, in the past, study how the REITs actually performed during the rate cut. Okay, so interestingly, we only have the data starting from 2003, 2004, because the first REITs got listed, CapitaLand, More Trust, right, in 2003. But I started with last 20 years data. I look at the 2005, when the rate started to go up, the REITs performance have done pretty well at that time. Okay, because that was during the bull market where the rates were going up, the rental income also were going up at that point of time, right? So the prices also have gone up significantly, and then the cut started to come in 0809. That was during the global financial crisis, right? And Lehman Brothers collapse. REIT prices did also, they tumbled, I think, almost more than 50%, right? And that was one of the worst time. And so rate cut during that time was bad because
of the overall economy. Yeah, it wasn't so well.
So now we are in a different situation altogether. Okay, so and then the other rate cut that we've seen is in 2020 during COVID, and the performance of REIT also didn't do well. Okay, so this time around, so it seems like the last 20 years, during the rate cut situation, the REIT seems to be not doing well, right? And that was largely because of that COVID and 0809. But this time round, unless there's another black swan event, okay, I think this rate cut will benefit REITs in general. Like I mentioned, mainly because for the last couple of years, REITs prices in Singapore have been beaten down. Okay, because of the steepest hike that we've seen at that point of time, right? And now, because of valuation that were quite low, I think we talked about this in the late last year. We talked about REITs prices were coming down, very attractive, right? And in the middle of last year, this year also, or early of this year, I can't remember which exactly, but it was very attractive. Like we did mention in our roundtable, one of our roundtables at the time. So basically, I think we are at a very interesting situation where REITs prices are cheap. At the same time, there's a catalyst, which the rate is potentially going to come down, right? And a lot of good quality REITs have managed to increase their rent, the reversion, right? They managed to renegotiate the rent, the good one, okay, at a higher rate, right? And that will again flow down, right? So any interest cost saving moving forwards, that will naturally flow straight into the distribution per unit, which we're likely going to see an improvement starting next year. For good quality REITs.
I think this is a thing that we've been covering for some time, because even at that point when REITs were beaten down, some of the pretty good ones had some decent yields still, right?
Yes.
At that point in time, I think it was like 5%.
Correct.
Which is pretty good. But at that point, some people have gone, I don't know when this interest rate environment thing is going to change. I'd rather put my money somewhere else. Yeah. But now you say REITs have come up a little bit. They've risen the last few months, right? And the yields are still decent, are they?
They're still decent.
But now there's actually a catalyst involved where it's likely that the rates could come down, and that could be a direct boost to the performance
of the REITs. I think we are already seeing it like for the last couple of months. REIT prices have done pretty well in general. But right now, at the time of this recording, it's still at quite attractive, all right? Not as attractive as it used to be, all right? It's just that there's still a potential room. I think REIT prices will continue to do well.
So definitely, this is an area that for those who are still waiting for REITs. This is something they could look at.
But again, by the time this recording goes out, I don't know how the price of REITs at the time. But if they ran up too quickly, like I said, second half DPU performance come out, the reports come out, it's going to be bad also for majority of the REITs because they are going to have lower DPU. The market may like, I overreacted to this good news, and then I'm going to sell it down. Okay, so that usually happens that way. Okay, so I think don't get too happy too early, because second half, I think we're going to see more result of REITs that seeing their DPU come down.
But that's looking backward.
Yes.
Looking forward, I think that's going to be different.
Generally, I think there's going to be a positive development for entire REIT sector.
All right. So that's for REITs, something that I guess we're going to look at. Probably may cover some more REITs in a future roundtable. Because things are looking up and they're still relatively undervalued at this point in time. So this is for Singapore REITs, just to be clear, not global REITs. Any other things that you'll be looking at?
I think we can look at the Singapore Bank, which a lot of people is looking at also. I mean, a lot of times you look from the chart, the banks are actually very sensitive to the interest rate environment, right? You can see back in 2000, right, when the interest rates start to cut, but usually when the cut is very steep cut down, right, because of the crisis, right? Back in 2000, it was the
tech
bubble. Then you have your 9/11, right? So that was a very sharp down, and you can see that the bank's stocks actually goes down together with the interest rate, right? And you look back in 0809, it's the same thing also, right? Sharp down, the share price drop. Back in 2018, they peaked. Then the next moment, when they flat, they drop a bit. And when the COVID happened, I think if the COVID did not happen, it won't be that sharp drop. But because of the COVID happened, it also was a sharp drop because of the MAS regulation. And also there's a lot of bad loans and all this because people can't pay because everything is closed. Right. So I think currently the bank situation, we are in a very unique situation that you never seen before in the past. Okay, let me show you why I'm saying that. Okay, if you look back in the yield, I have this table over here, right? Back in 2000, right, during the peak of the SG banks, the average yield of the three banks, right, is about 1.27% dividend yield, right? But the 10 years SGS Singapore government securities bonds, right, was 4.8%, 4.48%. 4.48%. Okay. So, and the banks is 1.27%. It makes more sense to sell the banks and put in a safe asset at that point of time.
It's risk-free, right?
Yeah, it's risk-free.
Yeah.
So why, actually, like what Warren Buffett says, you always have to compare back with the bonds and you look at the opportunity cost, right? Whether it's risk-free or what's the opportunity, right? So back in 2007, during the peak of the bank cycle, right, the average yield of the banks, the 3 Singapore banks, is about 2.53%. And the 10 years SGS bonds, right, was 2.92%. So the banks is trading lower than the thing with the risk-free rate, Then after that, back in 2018, the same thing happens, right? When they pick, the yield was 2.73%, the 10 years SGS was 2.6%. So they are not below, but they are very close to the risk-free already. Just about, the spread is only 0.13%. Okay, but what happened if you look at right now, right, in September that we're seeing now, okay? So the Singapore banks average trailing 12-month dividend yield is 5.66%. And your 10 years SGS is 2.71%. So it does not make sense to sell the banks right now because your banks are still giving you such yield. Let's say, example, people like me, that I bought my OCBC at around $9, right? My yield on cost is as high as about 9%. Because OCBC last year full year is about 8.2%. Trailing yield is about 82 cents. But now the trailing one is about 86 cents.
Okay.
So my yield is much higher right now, right? But if I were to sell my bank, yes, I can get my capital.
Where can
I put it?
Yeah. Singapore saving bond, 2.7%.
Yeah, it's even lower than my bank. I should just hold on, right? Until when it makes more sense for the, like, there's an opportunity cost down there, right? And the banks are, the yield are traded lower than the risk-free, then it makes more sense to switch to the risk-free assets.
So I guess those who are watching this and go, oh no, banks, I mean, interest is going to come down. Maybe I should sell my banks. That's not the way to look at things, because that's a very simplistic way, just one factor affecting another thing. But actually, you can look at the whole picture.
No, because I'm saying that this situation is very unique because of the sudden spike in interest rate. And in the past, right, before the interest rate start to cut, the banks are already traded very low compared to the then. But right now we are not in that situation. It's a very unique situation.
Okay.
Right. You sometimes, yes, I mean we can look at the past history, but we also must compare back to the fundamental, the opportunity cost and all this. Right. So right now it does not make sense. To sell the banks. So
this rate cut potentially really shouldn't, I guess, influence your bank decisions so much, and Singapore banks specifically, because the yield is still pretty good at 5%.
So right now the banks are facing very high interest rate environment. So the loan growth, right, is very low single digit.
Okay.
Right. So if the interest rate were to cut, we can expect more of their loan growth to come up. Okay. But you can see that all the Singapore local banks, the 3 of them, right, their non-interest income are coming up. Right. If the interest rate is going to cut, it's going to benefit the non-interest income. So from the non-interest income, you can already see, like, from their credit card, from their other fee income, right, their wealth management, they are going at double digit, mid double digit, mid teens double digit, right? And some of them are doing like 20%, right? So it's the non-fee income. You look at all the banks based on their history, right? When the interest rate are low, right, the non-fee income is the one that supported the interest income, right? So then if the yield makes sense, right, you just wait for the next cycle where the interest rates maybe come down and go up again. That's where they have a bigger loan because of the loan growth of the low interest. And when the thing re-rate again, then they will get a higher income from there.
Okay.
Right. Yeah.
So, I mean, a lot of times based on this, it seems like whether interest rates go up or down, you still look at the whole business picture.
Correct.
And if the banks are still doing well, you probably don't sell them. Is that what you would do? Unless it goes to a crazy valuation, which, like you said, in 2008, 2007, basically. Then you go like, hey, actually, it doesn't make sense for me to hold on to this.
Because we are still a fundamental investor. We want to look, at the valuation of the banks and does the yield make sense for me to sell off now? Right. I'm showing the yield 5.66 is not like based on the yield on cost, but it's based on the yield on the current share price. Right. It's 5.66.
Okay.
Right.
So I guess that answers your questions. If you're looking at banks, we know what this interest rate thing is gonna move
but
things
this is
too much.
Our own.
This is our interpretation. We have no recognition buy or sell anything as usual on our roundtables. We're not going to tell you to do anything. This is based on what we do the research for ourselves, because we make these own decisions for our own investments. We just share it with you because we invest in banks. So disclaimer: we own shares of the banks and some of the Singapore REITs as well. And this is what we think about how this is going to play out over the next few months and our decisions moving forward.
Again, for most of us, if you're really scared that bank is going to suffer because of the rate cut. If let's say the rate cut potentially going to be a very steep rate cut, then bank, I think the prices are likely going to come down, right? Because that may affect their net interest margin, and they don't have time to react to that. And that's why we always go back to our drawing board, right? Hedge against your bank investment against your REITs, okay, or vice versa. Right. So because these two really they are always tends to correlated to the interest, highly sensitive to the interest.
Negative correlated? Is that
negative correlation for the REITs
and the banks.
And then positive correlation for the bank.
Yeah. So the banks and REITs are negatively correlated.
Yes, they're negatively correlated. So in a way that you can always hedge them, side by side.
That's what you like to do, right?
Yeah, that's what I like to do. And both assets are generally very stable. Okay. Yeah, for Singapore context. Of course, you have to pick the right one.
Yeah, that's true. You just don't. I mean, you can't just throw a dot and then buy whatever REIT you land on.
Yep.
I mean, the banks are easier. It's only 3, but it's one of them is okay. But yeah, so this is I guess your near-term view. Of what's going to happen, and we're going to focus on REITs and banks here, Singapore banks and REITs, because this is what we look at.
So basically, I think I would say that hard to imagine that the bank will collapse in September. Hard to imagine. Use the words.
No, the banks, or you mean the rates?
The way I put it, I want to put in the Fed official format. Some people are worried the bank is going to crash because the rate is going to cut. Okay, I think hard to imagine that the bank will crash in September.
I don't think so. So I think what we try to do our best here is that we try to remove as much of the noise as possible and the short-termism some people may have, because this is going to happen, that's going to happen, what are you going to do? But actually, a lot of times we just got to zoom out and view the whole picture. And actually, it's not much of there's not much drama here, actually. In a sense, it's just like, okay, this is the situation. How do I apply it? What makes sense? What makes sense for me? So for now, REITs, for example, still relatively undervalued. If you're looking at that, good time to have a look at them. Again, no recommendation, but just nothing wrong with a good REIT at a good valuation and with a potential catalyst coming up. All right. So I think that's what we think about interest rates. Okay, so we don't know what's going to happen. It's going to come out pretty soon in September. So as of this recording, we have no idea what the Fed's going to do. But is there anything else you want to share about this?
Yeah, I think you should stay invested and don't try to time the market or invest based on interest rate movement.
Okay. So it's just you can't go like 100%. Interest is down, I do this. You have to look at it as a whole again. So like what you're looking at.
I mean, it's very hard to predict.
It's hard to predict.
I told you the Fed may flip flop. Right. You never know. You never know.
Okay. All right. So with that, I think that's pretty much what we have for today. So my name is Adam. That is Rusmayan. And Victor.
Thank you.
Thanks for joining us. Any questions about this, we're happy to answer them, discuss them with you in the comment section, of course. If you like this roundtable, please hit the like button. That will help us so much. And subscribe. We will always have more roundtables about this, and we'll see you again.